Greetings and welcome to the latest episode of Legal Bites, the official podcast of Cummings and Cummings Law, where our primary focus, at least right now, is on assisting businesses and their principals re-domesticate out of volatile, high-tax environments like Massachusetts to predictable pro-entrepreneurship, pro-growth jurisdictions like Florida and Texas. Today, I am reviewing a recent report by Kara Miller reporting for the Boston Globe on March 16th entitled Everyone's Leaving: Why More of the Wealthy Are Moving from Massachusetts to Other States. But first, a brief introduction. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business, tax, and commercial law throughout the states of Florida and Texas. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, as well as a bachelor's degree in accounting and a master's degree in taxation, in addition to 11 professional licenses and certifications covering accounting, tax, audit, and of course, the law. My firm website is www.cummings.law. Now, on to business. According to this Boston Globe report, Paul Karger manages investment portfolios for wealthy families in Boston. He's the co-founder and managing partner of Twin Focus, and he told the Boston Globe something that should alarm every business owner in the Commonwealth. About half of his Massachusetts clients over the last 5 years have either left or are planning to leave. That represents, in his words, billions of dollars in net worth and hundreds of millions of dollars in annual income and tax base walking right out the door. And the IRS data confirmed that. According to migration data released in March 2026, nearly 30,000, that's 30,000, not 13, but 30,000 more people left Mass than came into it from 2022 to 2023. Those departures represent a net loss of about $4.2 billion in adjusted gross income. And within the highest earning bracket, those earning $200,000 or more annually, almost 9,000 more individuals left the Commonwealth than came into it, representing about 30% of the total net loss. And the top destination for Massachusetts departures: Florida. The Massachusetts Society of CPAs surveyed its members and found that 40% of CPAs said they have seen anywhere from 1 to 10% of their clients exit Massachusetts, with Texas, Florida, and New Hampshire the top destinations. Much of this planning accelerated in late 2022 when Massachusetts voters approved the so-called millionaire's tax. The new law imposed an additional 4% tax on income over $1 million. Since the state tax rate is 5%, that effectively means income over $1 million is taxed at 9%. And this is not limited to people earning 7 figures in salary. It could also apply to someone who, for example, sells a $1.8 million house, even though the person might only make $200,000 in salary. A one-time real estate transaction can push a lower middle-class homeowner into a 9% bracket that was sold to voters as a tax on the rich, but the damage extends beyond the tax itself. According to the report, Boston-based venture capitalist Antonio Rodriguez, a managing partner at Matrix, told the Boston Globe that the millionaire's tax was passed without a genuine debate about whether it would make sense for innovation in the state, which has historically had a track record for serious innovation, particularly in pharma and biotech. People assumed that the ecosystem would keep producing. He said the thing that scares him now is that the AI wave is spinning in Silicon Valley with Anthropic, OpenAI, Cursor, and similar ventures. And instead of seeing some of that diffusion come back to Massachusetts, which would have been typical of prior waves of innovation, there is nobody left to pick it up. That is the second order consequence that most people miss. It is not just about the marginal tax rate. It is about the signal that marginal tax rate perpetrates. The wealthy are mobile, capital is mobile. And when a state passes a tax that communicates hostility or even outright antagonism toward the people who fund companies and create jobs, those people do not fight, they just leave. And when they leave, they take their businesses with them. This is where redomestication enters the conversation. Redomestication is the legal process of transferring the home state of an existing company from one state to another. You keep your existing federal employer identification number, you keep your contracts, you keep your bank accounts, you keep your credit history, and in almost every case, you maintain your existing business name. The company that existed before the redomestication is the same legal entity that exists when it is completed, and nothing changes except the state where the company is legally domiciled. It is a non-taxable reorganization under the Federal Internal Revenue Code when it is performed by a competent attorney. Redomestication, when coupled with a change of personal residency and a reduction or cessation of business activity in Massachusetts, can be an effective way to reduce or even eliminate tax nexus in the Commonwealth. For owners of pass-through entities like most limited liability companies, subchapter S corporations, and most partnerships, the state-level savings can be monumental. If you are a business owner with income over $1 million, Massachusetts is taking 9% of every dollar above that threshold. Florida, in contrast, takes zero. Texas, in contrast, takes zero. Over 5 years, the compounding difference is not trivial. It is the difference between building wealth and subsidizing a jurisdiction that has declared your success to be a policy problem to be dealt with. And Massachusetts is not done. The estate tax threshold in Mass is about $2 million right now. The vast majority of states have no state level estate tax at all, including Florida, Texas, and even California. A $2 million threshold means that a business owner who has built a successful company, purchased a home, and maintained a life insurance policy can trigger estate tax liability without being rich by any reasonable definition. That is yet another factor in the out-migration acceleration. Now, let me address some alternatives to redomestication because there's so much confusion and misinformation online, even by otherwise knowledgeable professionals. First, let's start with foreign entity registration, sometimes referred to as foreign entity qualification. Under this option, your company remains domiciled in the Commonwealth of Massachusetts. You register in a new state, but you remain subject to Massachusetts taxes, filings, and annual reports. You now manage 2 or more compliance tracks instead of just one. You save nothing. You have changed nothing about your tax exposure. Rather, you have just doubled the paperwork while remaining fully exposed to the tax and regulatory burdens that motivated you to consider moving in the first place. Now, old school merger is still sometimes used, but in most cases, it is not necessary to accomplish a redomestication. So I will distinguish that from a traditional merger. A traditional merger, which I will refer to here as option 2, requires forming a new entity in the destination state and merging the old entity into it. Emphasis on the words new and old. The old company legally ceases to exist. You may need a new federal employer identification number. You may trigger a taxable event, especially if you attempt to handle it on your own. You will likely need to retitle assets, novate or renegotiate contracts, and open new business bank accounts. Legal fees can reach $10,000 or $20,000 or more for a simple merger. And if a planned consent is missed or an assignment clause is misinterpreted, you may have transmuted what should have been a simple administrative exercise into a substantial business disruption. Now, behind door number three, let's talk about dissolution, sometimes referred to interchangeably as termination, although those are actually two distinct legal events, but we'll call it dissolution to keep things simple for today. Dissolution is the death penalty, it is the firing squad, it is lethal injection, it kills the company. Sometimes I get on the phone with prospective clients and they proudly boast, "Oh, I've already handled the dissolution, so you can give me a discount, right?" And sadly, I cannot because there's nothing left to move. Under a dissolution, you lose your liability protection, you lose your credit history. If claims surface after dissolution, and they do more often than you might think, those claims land on you personally because the corporate veil is no longer in existence. Unless you are truly going out of business and shutting your doors, dissolution is not a relocation strategy. Now, the most important document in a properly attorney supervised redomestication is the plan of conversion. It is a bespoke legal instrument. It is not a check the box or copy and paste exercise. Without it, your filing with the Secretary or Department of State may now have no legal effect, or it may result in the unintentional termination of your company. LegalZoom and Rocket Lawyer and similar services cannot prepare a plan of conversion. They are not attorneys, they are not law firms, and therefore they do not owe you fiduciary duties. And the advice from GPT, Gemini, and even Claude on this process is still wrong as of this recording. My law firm handles redomestications for a flat fee in almost every case. The entire intake takes less than 5 minutes at my website. I personally prepare every document, file with both states in the correct order, I might add, and send you weekly status updates via email until the transaction is completed. And I back it with a 120% money back guarantee. The reason I'm able to do that is because I have a 100% success rate to date on redomestications. If you have questions regarding redomesticating your existing LLC or corporation, please use the link in the description for more information on this intricate process and to schedule time for us to speak about your specific scenario. Again, my name is Chad Cummings, and I hope that you found this information useful. As always, the information in this presentation, like all of my presentations, is general in nature and it is not legal advice, because legal advice, by definition, must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my earlier presentations, please visit my firm website at www.cummings.law, not .com, but .law, to schedule time for a consultation. I look forward to the opportunity to speak with and perhaps even work with you very soon.